Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, April 10th, 2024 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for what looks to be a rather rough open on Wall Street. We did just have the March CPI number come out. That was out about 30 minutes ago. Futures immediately took a big drop as the core CPI came in, rising 0.4%, as opposed to the expected rise of 0.3%. This is the second straight month that we have come in a little bit hotter than expected, at least up at that 0.4% level. And if you multiply 0.4 times 12, you come up with 4.8%. And we've been on this declining path on the 10-year Treasury, on the core inflation rate, core CPI rate. And so it's going to be really interesting to see not just where we open today, because I don't really pay too much attention to opens. I mean, obviously it's down a lot. And if you got money invested on the long side, you're going to be down. So it's not like it doesn't matter. But in terms of what I see going on down the road, it matters a lot as far as where we go from this open to the downside. So we've got a lot to talk about this morning, but let's first take a look at what happened in the market yesterday. So yesterday we had the Dow Jones Industrial Average flat, down 9 points. S&P 500 up a little bit more than 0.1%. It rose about 7.5 points, sitting a little bit above 5,200. NASDAQ 100 up about 0.4%. That was up about 70 points. Mid caps up 0.1%. Small caps up 0.4%. So yesterday we saw really the NASDAQ 100 and the Russell 2000 leading, but mostly we were fairly close to the flat line with just maybe a little bit of a lean to the bullish side of things yesterday. Transports jumped about 0.25%, moving back up off of the moving averages. That will be a good one to watch today, because I would imagine with the gap down, we're probably going to see the transports at least down to the moving averages, maybe down below it. We'll have to wait and see. The other one to watch, as I was looking at the pre-market action, small caps getting hit harder, which honestly makes sense. I mean, if you think that inflation is going to be a problem, and it was this morning, then it will send yields higher. And as we have seen recent history, when the yields go up, the IWM takes the hit the hardest. And if you think about what I've talked about, what I see coming down the road, which is lower interest rates, especially short-term interest rates, that requires cutting of the Fed funds rate. When you get inflation reports like this, you have to at least be thinking, well, maybe we are going to be delayed. This is, again, 2 straight readings of the CPI at 0.4. Number of the Fed officials have talked about that being a bumpy ride in 2024, that inflation wouldn't go straight down. Well, we're seeing some of that bumpiness here in the last couple months. But again, what I want to look for is not necessarily what happens at the open, but what happens during the day, because institutions are not getting out. I don't know if you were watching futures at 8:30, but when the news came out, I mean, futures tanked. There was no time in the pre-market with market making participation optional or voluntary. There was really no way large institutional positions could be liquidated during that time frame. So it's really what happens during the trading day. And so I'll be watching to see the growth ratios versus value. If you think back, I think it was in 2021 when we saw growth take a hit for about 3 months versus value. I'd have to go back and take a look at that, but I think it was February to May of 2021. Anyhow, we could be in for something like that. I don't think we are, but part of it will be evaluating what happens during the trading day. So I'll show you a chart later in the session that I'll be watching pretty closely, not just today, but over the next few days to a couple of weeks, to see what kind of rotation we're getting in the market. Moving on to the sectors, we had real estate yesterday leading up almost a little more than 1.25%. Utilities up more than 0.5%. Technology up about 0.5%. We haven't seen technology leading much over the past 45 days or so, but we did get a little bit of leadership from technology yesterday. I would certainly expect that we would see technology getting hit pretty hard today. But if it's not, and if it turns out to be one of the relative leaders today, that would be a pretty good clue that Wall Street still is banking on this being nothing more than a bumpy ride and that inflation continues to drop. But again, it's too early to make that call. Let's see how that trades throughout the day. Moving on, one of the real estate areas, diversified. REITs came up yesterday about a little more than 3% and challenged the 50-day. Looks like it closed just above that 50-day and the 20-day moving average. Took out both of them yesterday, but the reaction high that we saw back in early March still has not been cleared. So real estate, which could be a beneficiary if the market starts to rotate because of possibly higher inflation expectations, that'll be something to watch. All the defensive groups would be a good area to watch. But anyway, we did see that breakout in the diversified REITs yesterday. Definitely a group that could benefit on a relative basis from this morning's CPI news. Renewable energy making a continuing push to the upside. This group looks really strong now, all of a sudden breaking above all recent highs, moving to a 6-month high. A lot of that is due to First Solar, because First Solar plays a big role in this index. I'm looking to see some other long-term solid players in this group, particularly Enphase Energy, to see if Enphase Energy can make a similar breakout. If you look at a long-term chart on ENPH, that's Enphase Energy, this is a company that can really move fast to the upside as it can to the downside. We've witnessed that probably over the last year or so. But this is a stock that can continue to push higher in very rapid fashion. So let's keep an eye on those two stocks in particular, First Solar and Enphase Energy. Finally, non-ferrous metals. Of course, this is mostly FCX, Freeport McMoran. That's the stock that really dictates this particular chart. The group, though, has been going higher. Obviously, FCX has been going higher as well. And there's a couple of areas, again, that maybe, we're talking about maybe renewed strength in real estate. Many of the materials areas, energy's been strong. Those areas that have been strong recently could continue to remain strong given a higher inflationary environment. But let's see. Again, I want to follow the action throughout the day. I don't react to gaps. We've seen plenty of times what happens when you chase gaps to the downside. Usually doesn't work out well, or it hasn't over the past couple of years. So just be really careful about that. But no doubt that the news was bad. I'm not trying to downplay the news. Inflation certainly was higher than expected, and it's done that now a couple times. The Fed's already, you've heard from a couple of different Fed presidents and others involved in that area. Maybe not necessarily voting members of the committee, but still influential members talking about, hey, we might not have rate cuts this year. Well, if we keep getting inflation readings like this, we won't. Certainly the Fed's going to be making sure that they're squashing inflation, and that has been maybe a little bit of a question mark of late. And the Fed's been talking about it. I've been bashing the Fed because of it. But maybe it's Powell that's getting it wrong. I mean, who knows? He stuck to his 3 rate cuts this year just 2 weeks ago. Be interesting to see what some of the Fed officials, especially Powell, are saying after this latest news on the CPI. Taking a look at the 10-year Treasury yield. All right, I'm not sure what's going on over at stock charts. I've been watching, but this has been stuck for this the last couple of days. We did show the TNX falling yesterday here, but I'm not showing anything for today's action, which is not normal. Bond market opens at 8:30 as opposed to 9:30, so we should be seeing some changes here. What I can tell you, though, is that, get you the latest. It looks like right now the 10-year Treasury yield is up 12 basis points to 4.49%. And if we go back to that daily chart, that would be a breakout over the recent high. And one of the things we talked about recently was the fact that the yield was moving up. We put in a cup, put in a handle back to the 50, 20, and 50 moving average, and then broke back out again. And that cup measures from about 435 down to about 405. Let's call it 30. Actually, I think it might be 31 basis points. Anyway, that breakout, you add the depth of the cup, which is 31 basis points, to the breakout level at 435. That gives you a measurement of 466. So today's gap up to 449 or wherever we end up later today is certainly a push in that direction toward that 465 measurement. So I would expect that we are going to go up to that level. And if we do, that is likely to continue to put pressure on equities, especially small caps, which have not handled the rising yield very well in recent months. Let's go ahead and move on. I did mention that both the headline and the core CPI came out this morning. If you're tuning in late, they came out this morning with a rise of 0.4% for the month of March. They were expected to rise 0.3%. And you might say, hey, it was just a little bit, not really that big a deal. And that may be the case, but this is now a little bit of a pattern developing. And those who think, hey, inflation's not done, we're going to go back up again, this would certainly add to your argument, no doubt about it. But let's see how the market trades. Again, I'm not going to overly concern myself with gap downs. What happens when the stock market opens and we start seeing a lot of money changing hands? Where does the money go? That's going to be an important question for today and for the balance of the week and the next couple of weeks. And don't forget, we have earnings starting on Friday, and we got the PPI coming out tomorrow. So the fireworks, which started at 8:30 this morning, may not be over. I'll be here trying to help guide you through all this. Anyway, S&P 500. So we've been sideways consolidating. I can tell you, let me give you where it looks like we will possibly be opening here in about 18 minutes. Right now, the spider down 1.5%. So that takes it down to 511, which would probably 1.5% would take us down, what, about 78 S&P points, which would take us to 5131. 5131 would take us below that recent low right here of 5146. So it certainly would look to me like at this point, if we open where we look to be opening, I believe we're going to hit that 50-day. Been talking about that really for the last month and a half to 2 months, that the negative divergence, if we did see selling, we could see that 50-day moving average being tested. If we fail to hold the 50-day, right now we probably going to be trading up above it, maybe about 0.6%. Again, based on where we are right now, we could go lower though between now and the open. That's 18 minutes away. If we were to drop today and close below the 50-day moving average, obviously on the daily chart, that would look horrible. But let's keep in mind, zooming out onto the weekly chart, we have no negative divergence. And where is that 20-week moving average? The 20-week moving average, which during secular bull market advances, in my opinion, is, especially when you've got a strong PPO, that rising 20-week moving average is the best support level on a stock or on an index or on whatever. And that is currently at 49.67 and rising. So if we open at 51.30, we probably still have potentially 2.5% to go down to what I consider to be a really big test, which would be the rising 20-week. I mean, if you go back and just look at secular bull market advances, you'll see that when we pull back to these moving averages, we tend to hold. I mean, here we had one close below, came right back up above. I don't know if we closed a little bit below there, came right back above. Anyway, this whole move, it wasn't until we had these negative divergences in play, along with a lot of bearish signals, that we actually saw a lot more selling than the 20-week moving average. For now, until proven otherwise, I'm going to stick to that 20-week moving average. Any kind of additional selling that we see, I believe, will be held by that support area. Let's take a look at the NDX, because on the QQQ, right now we're down 1.5%, 435.49. Just got done talking the last couple of days about that support at 433. Right now, 435.49. Looking at that rising 50-day moving average, 50-day moving average, that's at 17,941. If we go down 1.5% today on the open, that would be roughly 270 points, which would take us down to 17.9. The 50-day is at 17,941. So potentially, if we open right where we are in with futures right now, we're going to probably be pretty darn close to that 50-day moving average, maybe even slightly below. And on that selling from last Thursday, our low hit 17,875. So we're likely to be opening right down near that level this morning. And so we want to watch that on the NDX again. On the QQQ, that 433 level will be important. Moving on to the IWM, this one may be even a little bit bigger and a little stickier in the short term, because if we look at the weekly chart, I'll come back to the daily, but if we look at the weekly chart, remember, we've got that rising 20-week moving average right now, 198.21. So think 198. IWM pre-market right now is 200.69. So we're pretty close. At this level, we might have 1% or so down to that rising 20-week moving average. So while I'm still bullish. I mean, I'm not going to change based on one day's report and one day's gap down. It's going to take a lot more than that for me. But you recognize the drops and you look to key support levels. On the IWM, 198 and change, 198.21, that is the number on that 20-week moving average. Doesn't mean intra-week we can't go below, but come Friday, I would like to see us close, make sure that we're closing above that, not just this week, but in future weeks. You can see that PPO, weekly PPO has been rising. So again, pullbacks should hold that rising 20-week moving average. So I think probably of all the various indices we've talked about, I think IWM is the one we need to watch the closest. Next up, the transports. I can look and see what the IYT. Well, the IYT, and this was as of 25 minutes ago, after 8:30 though, was still showing up this morning. I don't know. I'd be surprised if transports are up today, but we'll follow that. IYT doesn't get traded as much. It's only averages about 150 or 200,000 shares a day, so it may not be giving us a good read in pre-market. I would expect that we would see transports lower. Watch the moving averages there. They both come in close to that 15. Looks like the 50-day is at 15,830, and the 20-day is 15,885. And we closed yesterday at 15,970. So even a 1% drop, which would be 160 points, a 1% drop would take us below both of these moving averages. So if we do see that at the open, what we'd really like to see is buying throughout the day and perhaps put in some kind of a hollow candle and hold those moving averages. Otherwise, the transportation group is potentially poised to make another run down to 15.4. Not exactly what I want to see, but it is what it is. We deal with what happens on the chart, what happens in price action. Again, it's not so much the news. It's not so much the opening gap. It's what happens during the trading day. That's what we really need to focus on. So is this a gap down with a lot of selling to follow, which would indicate distribution? Or is it a gap down maybe with intraday selling in the morning? Maybe we rally back in the afternoon. If we gap down, trade a lot of shares, and we finish right where we open, to me, that is not a bad day. I mean, it'll be a bad day in your account if you're long, but it's not a bad day in terms of forecasting what I think the market's likely to do down the road. because to me, that's not a sign of distribution. Anyhow, lots to think about today, and it's going to be an interesting day for sure. Moving on, if you head over to my home at earningsbeats.com, you can check out our chart of the day. Actually, it's 3 times a week that we show a chart with a couple paragraphs in our Earnings Beats Digest. Anyone can join. It's completely free. Name and email address, all it takes. Hit that subscribe button. Got a really good one for you today, and that is Apple. And what I did was similar to what I did back in 2022. If you remember, I talked about manipulation of the QQQ in particular. It also is with the spider. But the QQQ, if you look back in 2022, when we started the decline in that cyclical bear market, the QQQ, actually, maybe I can pull that up. I won't be able to show you all my annotations, but if we go back and we look from the last few years, right through here. So as we were going down in 2022, beginning of the year, we saw gap downs, but we also saw a lot of intraday selling. There was distribution throughout the trading day. 9:30 to 10 o'clock, there was distribution. 10 o'clock to 11 o'clock, distribution. 11 o'clock to 2 o'clock in the afternoon, distribution. 2 o'clock to 4 o'clock, distribution. For about 4 months at the beginning of the year, we saw a lot of selling throughout the trading day. It wasn't gap down and recovery. It was a gap down and further selling. When we got to this low in June, if you recall, it was literally right on this day, I had a video out and I said, I'm calling the bottom right here. One of the big reasons that I made that call was that as we kept moving down to new lows on the QQQ, something changed on the intraday trading. And what changed was we started gaining ground on the QQQ from 11 o'clock in the morning until 4 o'clock in the afternoon. In other words, we were going down, but the majority of it was because of gap downs. You can see a couple of them right here. Big gap downs. You can't really see which ones are hollow and so forth, but there were a lot of days where we were gapping down. We were coming back, finishing with hollow candles. It was suggesting to me that we had institutions that were willing to start buying. And when they start buying in mass, lots in mass quantity, big volume days and weeks to the downside. I mean, if you look at these days, you can see in May, June, very, very heavy volume. And when you start seeing buying appear in the afternoon, and I think I even wrote an article at Stock Charts back in May, probably around the middle of May, that said I could see a bottom nearing. And I started to see that type of action. 1 month later, we went lower, but it was only escalating. The buying in the afternoon was only escalating. So you have to understand kind of the mentality and what is taking place in the market. And I want to show you now Apple and what is happening to Apple. What I've done is I've highlighted everything that's transpired so far in 2024. Could have probably gone back here to the high, which would have included another couple of weeks. Anyway, I looked at 2024. It's one of the worst performing stocks in the Dow among technology. I mean, it's been a bad year. We were at 192 and change. We closed yesterday at 169. We're down $23, which is probably about 12, 13%. In a market where we've been seeing the market just keep going up, setting new highs. So Apple's been really bad. But you might want to take heart in this fact. As we've been going down, yes, we have lost $23 since the end of 2023. Apple has dropped $23. Here's the makeup of how it has dropped. Opening gaps down 23.89. So essentially, if you bought at 9:30 at the open every day, Apple, so far this year, you'd be flat. If you just simply avoided the opening gaps, you would have missed all of the downside action in Apple. Now, if that doesn't reek of manipulation, I don't know what does. Anyhow, 9:30 to 10 a.m., it drops on, this is cumulative. So I looked at 9:30 to 10 o'clock every single day since December 31st. And when you add all of those moves, all of those half-hour moves each day, you add them up, it nets to a minus $10.20. So now, if you were buying if you were buying Apple at 10 a.m. in the morning, you would have actually made $11. If you bought at 10 a.m. every day and sold at 4 p.m., you would be up $11 on Apple in 2024. So it's the gap downs and it's the panic selling in the morning that is driving it. 10 o'clock to 11 o'clock. Let me zero in again, make sure you can see this. So 10 o'clock to 11 o'clock, we've gone down 1.65. 11 o'clock to 2 o'clock, we've risen $7. From 2 o'clock to 4 o'clock, we've risen $6. Folks, the selling is at the opening bell and in the first 30 minutes, net. That doesn't mean that it's gap down every day. You have gap ups in there. I'm talking about the net. So for the last 3.5 months, Apple was gap down almost $24. And then it's gone down another $10 in the first 30 minutes of trading. Down over $34, but it's only down 22 and change for the year. So that means 11 and change, we've gone up after 10 a.m. And if you go wait until after 11 a.m., you have a little bit more net selling, and that's when the buying has been much stronger in the afternoon. I like afternoon buying. I believe it's a signal of strength. So when you've got price action going down and you've got afternoon buying coming in, I believe Apple is sitting about where the QQQ did back in June. Now, you might say, well, yeah, but we didn't bottom in June. We ended up bottoming in October. Give that to you. You know what? I thought it bottomed in June. And I think if Powell didn't have his Jackson Hole speech on August 25th that sent the market reeling, I think that June bottom would have held. But anyway, we got bottom 2.0 in October, and the rest is history. We've been going up ever since. This doesn't tell me that Apple can't go lower. We saw the QQQ end up going lower. Maybe Apple ends up going lower. We still have a low down here at 166. Maybe we go down and challenge that. But this signal with the intraday action, along with the positive divergence that now is setting up here, I mean, we've got lower prices on Apple, higher PPO. We've got technical reasons as well, suggesting that Apple is a buy here. Anyway, I thought that was a really interesting chart. I think their trading action here in 2024, while we've been going lower, I would hesitate to be overly bearish on Apple. I believe in time that this is going to be very meaningful information, and we're going to see Apple rebound. All right, it's almost 9:30, and I do want to stick around until we get the opening bell just to see where we open. But I want to show you first. I was looking at the CBOE equity options yesterday. So this was yesterday's action. And by the way, this is very, very light volume when you're looking at equity options. I've seen days where we're at 4 or 5 billion, or excuse me, 4 or 5 million shares or contracts. Here we had 2.6. So it was a pretty light day. But what I did notice is that we started off at 0.59 and we were kind of going up. These are cumulative readings. So 0.59 was just simply taking 162,000 divided by 274. 0.58 is taking 264 divided by that 452, 65. So, so forth and so on. So the cumulative number is going up all day long, and it actually started to pop in the final hour. Now the market rebounded in the final hour. So I thought that was odd, but it seems like there were some folks that didn't want the risk of being in for today's CPI report. And hey, I'll give you a golf clap on that one. Anybody had bought puts at the close yesterday, smart move. Obviously we don't know which way the market's going to go, but there did appear to be some hedging yesterday into the final hour, and that hedging paid off quite handsomely. Wanted to mention a chart, SMCI. It's been coming down a lot. It was obviously one of the hottest stocks of 2024. It's been reeling. It's down near recent support, which goes from about, looks like maybe 850 to 900. We closed yesterday at 900. There's your 50-day moving average. Here's your PPO center line about to be tested. It's going to be interesting to see if this stock, which I imagine is gapping down today, along with everything else, it'll be interesting to see if this puts in a hollow bottom. Way too early to say, down 25 bucks, but we're getting close to these lows and we're just below the 50. Do we have a hollow candle that prints at the 50-day moving average? SMCI will be an interesting stock to watch today. All right, the one chart I said that I'm going to be watching in the day is just my ratios. So I suspect that as the S&P drops, we're going to see a number of these ratios drop. So that's not going to be my concern. It's whether they rally back. We have seen as money is rotated toward value in the second half of the first quarter. By the way, historically, that is normal action. That's, if you look at seasonality, that'll tell you that's normal. You get through the middle part of February, money tends to rotate. It's not just in the first quarter, it's also in the second and third quarters. Fourth quarter is different with the holidays and being the most bullish quarter. But Q1, Q2, and Q3, the second half of February through the end of March, we tend to see many of the value-oriented areas outperform. It's not unusual at all. So now we're into April. We're heading into earnings season. Do we see a big breakdown? I imagine we're going to see a gap down. In fact, let's see if what we're doing here. Actually, it looks to me like we may have gapped up. I don't see a down move. If maybe flat. Well, the best way to check it out is to just go in and look at the sector summary, which is what we'll do real quick. And you can see right now, Dow down almost 500, S&P 61, NASDAQ 200. Not quite as bad as it was in the futures. We were showing 1.5%. Now we're 1.2 roughly. Small caps, though, still taking it on the chin. That's a pretty big drop in the small caps. VIX up about 9%, 16. I would have thought maybe we'd see a little bit more of a jump in the VIX with those futures, but we'll see how that trades. If we don't see a breakout in the VIX, if we see the S&P go to new lows, new recent lows, but the VIX doesn't go to new highs, to me, it's just a subtle indication that maybe the fear is not as bad as we might think. But again, that would be a very subtle interpretation. I don't know that I'd be doing a whole lot of trading based on that simply on one day, because we could see the VIX soar later today. But right now, just a little bit of a subtle bullish signal. Anyway, let's go in, take a look at these sectors. Let's see where technology is in the top half. Communication services in the top half. Two of our three aggressive groups are not seeing the selling. They're actually doing better than the major indices. So are we really at this point? Again, we're only 3 minutes into the open. We got a lot of, we could see big sell-offs in these areas during the day. So we want to keep watching it. But it's not really, we're not really seeing big sell-offs. Then we got financials and industrials, discretionary, and look at the three at the bottom. In real estate should do pretty well when we're talking about inflation. That's a group that actually is a hedge against rising inflation, rising prices. And yet it's the worst performing group by far at the opening bell. So my initial reaction is that, yes, the news was bad. Yes, we gapped down. If you're long, you're losing money. But early on, I'm not seeing anything that really worries me from a longer term perspective. Now that, again, can change. Watch the distribution among the different sectors today. Follow that chart that I just pulled up. And you can follow it, say, on a, sometimes I'll look at like a 15-minute, 10-day chart. So let's pull that up and see what it looks like right now and see what kind of reaction we're getting. So here's the move down in the S&P. So we're right back down to 5150, close to the low we had before. QQQ Spider, initial move is up. IWF, initial move is up. XLY, XLP is down. Large cap growth slightly lower. Mid cap growth up. Small cap growth versus value up. and transports versus utilities up. So if anything, it's a mixed picture, but I actually think more are pointing toward, the kind of the value oriented or more defensive oriented areas of the market underperforming, which if you're getting more inflationary concerns makes no sense whatsoever. And that's honestly why I like to follow what's going on below the surface. Now, that doesn't mean we're going to come roaring back. We could, but it doesn't mean that. It's just, I'm not going to be overly alarmed. I'm not going to be overly worried about the long-term picture when I see this kind of beneath the surface behavior. So we'll see how the day plays out. I do want to go in and look at that transport chart. See where, yep, we're down. That would have been really weird for us to be up. Transport's down 1.8%. And unless we get a big reversal, that would be bullish if we went back to the open or above the open today. But right now, looking pretty bearish on the transports, looking like 15.4 could come into play. One final check, and then we'll wrap this up. Dow still 473, right around 120. We're actually seeing the NASDAQ, though. The losses are actually dropping a little bit faster than the other areas. So that's probably a good sign. Small caps were 2.7. Now they're 2.4. Again, still a little early. VIX only up 7%, was 9%. Let's see how it goes throughout the day. I'm not going to give you a minute by minute, recap of what's going on. But I do have a live trading room today at Earnings Beats. I mean, this is going to be an interesting day. I don't know quite yet. I got to think about it over the next 23 minutes or so, whether or not I'd want to kind of jump in here. Some areas are at key support, though, on this drop. I showed you the S&P near the recent low. The QQQ was getting closer in pre-market to that 433. I mean, it's as you're getting closer to support, that is the time to take a shot. Anyway, we'll talk about that more in about 22, 23 minutes. For those of you who would like to join us, you go over to earningsbeats.com. All you have to do is start a no-cost trial. You'll have to give your credit card 30 days for free, but that'll get you the next 5 Wednesdays for a live trading room, which is at 10 a.m. each of those days. So hit that button, start your no-cost trial, and come join us here in a little more than 20 minutes as we take a look at this, what could be a really crazy day in the market. Have a great day, everybody. Make sure you like our video and subscribe to our channel. We'd love to have you. It certainly would provide us the kind of support on YouTube that we need. We would really appreciate that. Have a great day, everybody. Happy trading.